income tax. You earn the income. Now it's time to pay the taxes. So this is income taxes on the company's income. Payroll liabilities like salaries payable, wages payable, right? Commission, bonuses. So why there is a need of separate payroll? Because now corporations are becoming more and more, and especially management of the payroll is a huge responsibility. So that's why we have a separate department of payroll, because now employees are 5,000, 50,000 employees. Look at in China, they have more than in 100,000 employees. So, making or transferring amount or calculating their bonus, commissions, wages, salaries of the staff, wages of the part-time workers, it's a huge hectic stuff, right? So that's why the companies or big businesses, make a separate account and they call this payroll liabilities. So in those payroll liabilities, they have salaries payable, wages payable, commission payable, bonus payable. So if you have done any employment in China, so they will say that, okay, we are going to pay you 10,000, for example, plus multiply by 13. What does it mean? In a year, there are 12 months. Why they are multiplying with 13? And they say that, okay, 1 month salary is going to be paid you as a bonus according to your performance. And normally these are paid in before the Chinese New Year, right? Or the management, they say, okay, no, I want salary into 16. I want 4 months. And they are going to pay you after every 3 months. They will pay you one salary as a bonus, right? So this is how the salary structure works in China, right? So entries, you already know that. Luckily, we have an example here. So we don't have that illustration, but we do have the entry here, so we can also derive that. So this is the salary expense. So not all the salaries that is payable, you paid to the employees. Some salaries you deducted for employee income tax, for the federal taxes, and then you pay salaries. So employee will receive salary 8,000. Rest of the stuff is going to be like pension payable, all these income taxes, this kind of stuff, right? So the total salary of the employee is 10,000, but he will receive 8,000. So rest of the 2,000 is split into other payable liabilities, right? This is how the entry is made. And you will be given all the data here. You just need to, again, work on your debit credit rules. That's it. Expense increase, debit. Liability increase, credit. Asset increase, debit. Asset decrease, debit. Owner's equity decrease, debit. Liability decrease, debit. Right? This is how you make the entry. First, you write down the debit, and then you write down the credit. And how you pronounce it? Now you see, 3 things are credited, and 1 thing is debit. So you pronounce it salary expense, 2 employee income tax payable, 2 FICA tax payable, 2 salary payable. Right? If these are like 3 debits and 1 credit, do we have? No, we don't have. Yeah, we do have. We just
Teacher,
yeah.
I remember liability decrease. It was credit. It wasn't debit. No.
Liability increase, credit. Liability decrease, debit. Opposite of the asset.
Okay, understood.
Make sense?
Makes sense.
Good. I want to tell you, because some students, they, yeah, this entry, for example, We talked about that. So here we have 3 debit and 1 credit. And how we are going to pronounce it? Notes payable 8,000, interest payable 600, interest expense 200, to cash 8,800, right? And if there are no, this entry we just pronounce it like in payroll liabilities. So in which you see that there is 1 debit and 3 credits. And how we pronounce it? Salary expense 1,000, 2 employee income tax payable 1,200, 2 FICA tax payable 800, 2 salary payable 8,000, right? So the word 2 is pronounced before credit item, credit account. Okay. So salaries expense. So we just saw here that salary expense is not equal to salary payable, right? Salary expense is not equal to salary payable. 10,000 is not equal to, and why is that? Because there are several liabilities inside a person's salary. That is, it has to pay income tax, have to pay other taxes, pensions, like this, like that. So company must also pay employer payroll taxes as well, right? So that's why the salary expense is not equal to salary payable, right? Salary is paid after net of taxes. Unearned revenue, we already talked about that. Unearned, that you receive the money in advance, but that is not eligible for sales. Why? Because goods ownership are not being transferred to the customer. So we also call this deferred revenues or revenues collected in advance. So business receive cash before earning revenue. So this is until the ownership is transferred to the customer, you are not eligible to record this as a revenue, because revenue, you are not eligible to say that this is my sales or this is my revenue unless service is being delivered, or service is being to be offered, or goods are being delivered, or ownership, at least ownership has been transferred. So what is the entry here? So we have illustration here. On December 15, Southwest Airlines collect 300 for a round trip from Dallas to Los Angeles. I think we already talked about this in that lecture when we were talking about the current assets, liabilities, and all the stuff. So I think this example we already talked about it. So this is a round trip. So 300. So on December 15, the airline received in advance $300. So does the airline provide services to the customer and deliver that services from Dallas to Los Angeles? No. On December 28, the customer availed the flight, but company received the amount on 15th of December. So what will be the entry on? Either they will keep the money till 28th of December. If that happens, then this is the fraud. You are increasing the chances of fraud, motivation for fraud. So fraud triangle activates. So whatever is coming into the business and going out from the business on every day, whenever it comes, you record it. Whenever it goes out, whenever it goes out, you also record it. So cash is coming in the business. So entry would be cash to unearned. You create a liability. Unearned revenue, you can also say that here, or a traffic liability, because this is a liability, right? Unearned, you can also say that unearned liability or unearned revenue liability, right? On 28th of August, customer fly from Dallas to Los Angeles. but this is a round ticket. He also need to take airplane from Los Angeles to back Dallas. So on 28th of December, how much sales belongs to you? How much service you have provided? 50%. So $150 you are eligible to record among this liability. So you decrease the liability 150 and you increase your sales. Increase in sales, credit. Decrease in liability, debit. So air traffic liability or unearned revenue to sales. Right? 150. So this is how you record. On January 4, the customer returned to Dallas. So the rest of the amount on January 4, the rest of the amount also 150, it is you eligible to record as a revenue. So 150 unearned revenue to ticket revenue or air traffic liability to ticket revenue. So you see, first you create liability and then liability is decreased against sales. Right, guys? So Lota, Ploy, Fabian, Wuxiong, Ali, Florian, Nimesh, Kathleen. Understand?
Yes, understand.
Good. If you understand that, then here we go. We have a breakout room activity. All you need to do, I'm going to be, you need to do, take a picture. Meanwhile, I am setting up the breakout room activity for 3 groups. And this is a group activity. So remember the rules of the breakout room activity is that you must turn on your camera. You must turn on your microphone to start discussing, okay? And this is a group activity. Remember, turn on your microphone and turn on your camera. This is a must requirement for breakout room. So those who are watching the online, I'm going to be pausing the video and we are going to record again, resume recording after the breakout room activity. So here we go. Okay, class, welcome back after the breakout room activity. So let's compare our answer. So let me repeat the illustration here. So we have Wortham Publishing completed the following transaction for one subscriber during 2014. October 1st, sold 1 year subscription, 1 year subscription, and 1 year include 12 months, collecting cash of 2,400 plus sales tax of 9%. So entry would be cash collected 2,400 plus the 9%. Answer would be cash 2616. So they received the subscription in advance. So is this their sales? So their sales happened all of a sudden? No. They received 12 month sales in advance. So that would be cash to unearned revenue, 2,400, and rest of the thing is sales tax payable. Right, Florian? This is unearned revenue. Unearned revenue is our liability. And now what happened on November 15? November 15th, remitted sales tax to Californian state. So they paid sales tax. So when they paid sales tax, what is the entry? Cash decrease and liability also decrease. So when liability decrease, debit. So sales tax payable, they pay cash, cash decrease 216, right? So this they pay off. This